Assalamu alaikum friends. Welcome to Advanced Audit and Assurance Revision Series for September 2021. I'm going to conduct this revision series for 3 days starting from 13th of August, 13th of August, 14th of August and 15th of August. So let's go to the content of this revision series. What I'm going to cover in this 3 days revision series will be there are 18 topics that I'm going to cover and each day I will be taking 6 topics. So starting from regulatory environment. Today's video I'm going to cover the first 6 topics that you can see on your screen, starting with regulatory environment, money laundering, code of ethics and conduct, professional responsibilities and liabilities, quality control, and practice management. The other 6 I'm going to cover in the day 2 and the last 6 will be covered in day 3. So as you can see on the screen, planning, then we have transnational audit, evidence, completion, reporting, audit related services, review of interim financial information, prospective financial information, due diligence, forensic audits, audit of social, environmental and integrated reporting, and audit of performance information in the public sector. All this will be covered in day 2 and day 3. Because I thought that since exams are near, students don't have so much of time, some of them might not be so well prepared. So I thought that why not make the short revision for those students who do not have so much of time, especially those who are also working. So this will be beneficial for those. Now, before I go to the topic of today, let us first go in the content of the exam, how the exam will look like. What is the content? What is the style of the exam? So your AAA exam is divided into two sections, section A and section B. Section A, we have one question which is 50 marks, and this 50 marks, 46 marks are your technical marks and 4 marks are your professional marks. Okay. So in section A, you have to take care not only of your writing but also the way you are writing, the format that you are using. Are you writing your introduction? Are you writing your main body? Are you writing your conclusion? It matters. Okay. For example, if you are writing a briefing note or a report, you should follow the format of the report. Are you starting to whom you are sending, from whom you are sending? Are you writing the subject of the report, the date that you are sending? Are you using the proper heading? Are you using subheadings? Are you writing the answers in paragraph? All this matters in section A. Not so much in section B, but still you have to follow it in section B as well. At least writing in paragraphs and using subheadings and all. So in section A, what are we covering? In section A, we'll be covering the initial stages of audit, like planning, risk assessment, gathering evidence, ethical and professional considerations. Okay, section B covers the latter part of audit, completion, review, reporting, and it can cover any area of the syllabus from regulatory environment, ethical professional considerations, quality control and practice management, planning and conducting an audit of historical information, and other assignments. Okay, and current issues can come in any part of the exam, section A or section B. It can come anywhere. Okay, you have to be aware of the current issues as well. Now, let us go to the aim of the exam. What is the aim of this exam? Let us understand that the aim of this exam is to ensure that candidates can exercise judgment and apply techniques in the analysis of matters relating to the provision of audit and assurance services. It is not just audit, but assurance services as well. Because the subject of this paper is advanced audit and assurance services, right? It's just not audit. And can evaluate and comment on the current practices and developments. So it's just not that you have the right knowledge, but also you have to exercise your judgment while answering this paper. Now let us go to some success tips for this paper. What do you need in order to pass this paper? Number one, you have to answer all the requirements, right? Don't leave any requirements incomplete. It does not matter whether you know the answer or you do not, but at least write something, whatever you know about it. Do not leave anything blank. The moment you leave anything incomplete, you reduce your chance of passing. Okay. B. Strict with your time. Remember 1.8 minutes per mark. For example, if you have a question for 10 marks, you are going to spend 18 minutes only. 18, not 18.1, not too less also, because writing too less means you're not writing enough, but it should not be too much. 18. As soon as 18 minutes is over, you are moving to the next requirement. As soon as time is over for that requirement, you are moving to the third requirement. Like this, you keep on moving. Okay. And this rule of time is not only in your exam. While you are practicing also, you have to stick with this time. Okay. In any ACCA paper you take, this is the time given for mark, 1.8 minutes per mark in all your professional level papers. Coming to the third, remember that this paper is not how much knowledge you have. It is the way you apply that knowledge to the scenario given to you. You have to be very specific to the scenario. Your answers, you have to adjust it to the scenario. Because when you're learning the knowledge, when you're learning the standards, they are very general in nature. But how are you going to use it to the specific scenario? That's a skill that you need to adopt. You need to practice. While you're practicing, you have to see these things. Are you able to understand identify the issues, identify the problems? Do you know how to correct it? Do you know which standard applies here? Can you link it to the scenario? Okay. Fourth, take time to read and understand the full question requirement before reading the scenario. Now I always encourage my students, please read requirements before reading the scenario. Because scenarios are lengthy enough. When you read the requirements in your mind, you know what are you searching in the scenario. It should not be the other way around. Okay. Stick to these four things and you can guarantee that you are going to pass. And another thing, guys, which I have not mentioned in the slides, do not go with this mindset that audit is very tough. My friends are failing many times. I will also pass. I will just see. Okay, I will just give it a try whether I can. I'm very sure I'm going to fail, but I'm just going for it for the sake of giving the paper. Don't go with this mindset. Trust me. You are definitely not going to enjoy the process if you go with this mindset. You have to enjoy this learning. If you're not enjoying audit, you cannot. Trust me, you cannot survive this paper. You need to motivate yourself in this paper. You need that encouragement, that motivation that, okay, this paper is not so tough as I used to think. You have to go with this mindset that I can do it. Right? How you are dealing with other papers, exactly the same way you have to apply for this papers, because I can understand the nature of this is a little bit subjective kind of nature. You have to use your professional judgment. You have to write a lot also. No numbers also, no number crunching like financial management or SBR and all those things. No, not like tax also. It's a very different paper. Too much of writing, too much of thinking also. You have to use your creative thinking as well, especially when you're giving recommendations and solutions and all, which are very specific to the scenario. You need to think outside the box. You need to be very practical. Okay, but enjoy the process, especially in this last few days. Keep your mindset, be happy, and keep your mindset that you are going to pass this paper. Okay, next. So now let us go to the first topic, which is regulatory environment. Before we even go to the audit procedures, evidence, reports, and all, it's always better that you first understand what is the environment of that regulatory environment. They are very strict. Audit profession is very strict, that it is regulated by so many rules and regulations. That's why we are learning this regulatory environment. And under this regulatory environment, we are going to study three things. What are the main sources of regulation? Who regulates it exactly? What are the main bodies? Second, public side and corporate governance. Corporate governance is very much linked with audit. Okay, corporate governance is a topic on its own in SBL, but here we just need to know how it is related to audit and all. Public oversight. Who are going to monitor this? And then audit committees. Okay, so first let us start with the main sources of regulation. These are the three main sources of regulation. Number one, IFAC. Number two, ACCA's Code of Ethics and Conduct. Remember the five ethical principles of ACCA? What are they? Integrity, objectivity, confidentiality, professional behavior, professional competence, and due care. Okay. Third, we have IESBS, International Code of Ethics for Professional Accountants. This is also an ethical code, but this is the IESBS International Code. That the second one is ACCA's Code of Ethics for Conduct. It is only for the ACCA members and all. Okay, the other one is more international for all the professional accountants. Coming to the first one on the left hand side. All your standards on auditing, right? International standards on auditing, they are issued by IFAC. So IFAC is the board that regulates this audit. Okay, they are the one who provide basic principles, and also all the procedures in most of the audit areas are given by IFAC. What is IFAC? What do they do? They issue auditing standards through their committee. They have a standard committee. Okay, the international auditing. Okay, that standard committee is IAASB, International Auditing and Assurance Standard Board. Now in the exam you will not be asked what are the roles they do or the whole history of them, how they have built up, what are the standards that they issue. No one is going to ask you all these things. You just have to know that these are some main sources of regulation. That's it, briefly. Okay, what are the advantages of having this regulation? Any sources of regulation, but what are the advantages of this? Why regulation? It could be unregulated also, because if it is regulated, the mission is to establish high quality assurance. Okay, it provides a quality control and related standard services to develop the harmonization process worldwide, so that in the worldwide you can harmonize this process. Next, so that's it. Only this much is for your main source of regulation that you have to know. Next, we are moving towards public oversight and corporate governance. What is corporate governance? Corporate governance means public companies are managed effectively for the benefit of whom? The company and the shareholders. Now, you need to know some of the things that a good corporate governance require. Because this is a summary, so I didn't write anything in detail. It is provided in shortcut. It's like a summary of everything that you are going to learn. But anyway, you have to learn the detail and you have to do the revision kits and all. Okay, this is not the ultimate, but this is effective. You can take it as this one. This is not, you should not take this as a substitute for your own revision and doing past papers and all. But this is a quick way to go through all these concepts and all before the exam, 2 or 3 weeks before the exam. Okay, so there are some 7 things, the 7 things that a good corporate governance require. Because in the question you might be given a company, let's say, and the company might have a lack of some of these things. So then you need to say what are the lackings and what it should have. Okay, because these are good corporate governance. If any of it is of if any of it are lacking in a company, that means that company does not have good corporate governance relating to that thing. Not entirely, but if majority of this are not there, that means the company is not managing effectively. Okay, for example, the fair appraisal of performance. Appraisal of performance are fair. Remuneration and benefits that employees are receiving are fair. The board is balanced, 50% non-executive director and 50% executive director. Okay, and the non-executive directors, they have sufficient experience and authority. Then your financial reporting is fair. You have a constructive relationship with the shareholder, effective management, and sound system of internal control. Internal control is working perfectly sound. Okay, good corporate governance can be enforced in 2 ways. One is by law. If it's by law, everyone has to follow that. For example, in USA we have the Sarbanes-Oxley Act, or it could be agreement like through codes of best practice. Like example, in UK we have this UK corporate governance code. Okay, or you can use a combination of both the law and the codes of best practice. Next, we are moving towards corporate governance in action. Okay, these are the things that you need to look in your scenario that is given to you. These are the areas that you need to check for when they are telling you to comment on the corporate governance, whether it is strong, whether it is sound enough, or whether it is weak. How to say whether corporate governance is weak or strong? You have to see these points listed on your screen. Okay, so starting with the leadership in the company purpose, the board leadership and the company purpose. The leadership, they have an effective leadership. Effective board leadership is there. They promote long-term sustainable success. Directors should lead by example. That means the top level people, they are working effectively. Because if the top level people are working, they have this good culture that they are promoting. That means they are not going to accept bribes or anything like that. The culture set from the top is good. Directors are working effectively, the leaders are good, chairman, CEO, then the whoever is below them, they will be following it. You see, then everyone will be following, taking that culture, everyone will be effective and working. Because the people in the top level, the board leadership, they have an influence over the lower people. That's why when corporate governance comes, you have to see in your top level, are they performing well, are they functioning effectively? You have to see that in your scenario first. Whatever the chairman, whatever the CEO, whatever the directors, are they performing well? Then you need to check for the other things. Then second is division of responsibilities. How the responsibilities are divided among the organizations. Are the chairman and the CEO separate, or are there one person doing both the jobs? He is the chairman as well as the CEO. They should be separate. Two individuals, one should be the chairman and one should be the CEO. The board should be balanced. Balance means the number of non-executive director and the number of executive director, it should be balanced. It should not be that executive directors, there are 10 executive directors and only out of them, only 2 are non-executive directors. It's not balanced, right? Only 20% are non-executive directors versus 80% are executive directors. It's not balanced. So good balance would be 50-50. Okay? And half the board should be independent. That means at least 50% should be independent. Third, we are going to the composition, succession, and evaluation. How the board is composed. Succession means if let's say an employee is retiring or going off, who is taking place over him? Are there any processes in place that if one leaves, the other one can take over? And evaluation, how it is evaluated, the performances are evaluated. Okay, so the board appointments should be made by whom? The nomination committee, and majority of it should be the independent non-executive director, INED. Okay, the appointments that are made should be based on merit. That means the capability of that person, best person for the job, not on some pasta or something. You have to see that whether they have the skills and experience. Directors should be called for annual re-election, and the chair also must be replaced every 9 years. So if these are there in the place, that means company is having a sound corporate governance. In the scenario, if you see all these things are there, if it's against them, that means chairs are not being replaced for 9 years, there are no re-election of an employees, chairman and the CEO 1%. Okay, appointments are not made based on merit, then you can say the organization is having a weak corporate governance. Next, audit risk and internal control. Audit risk and internal control. It's not audit risk. Audit is a separate thing, risk and internal control. With corporate governance, all these things also comes. Okay, the board should ensure independence of internal auditor as well as external auditor. They should manage risk and oversee the internal control. It is whose responsibility to manage the risk, not the auditor. It is the board's responsibility to manage the risk and see the internal control. Audit committee should be established, and in that audit committee at least 3 should be independent non-executive director. Minimum, that's the minimum. There is no level to maximum. Okay, and the chair should not be a member of audit committee, because audit committee should be made of non-executive director, but at least 3 should be independent non-executive director. So chair is not a non-executive director, therefore chair cannot be a member of audit committee. And at least out of the members, at least one member should have the recent and relevant experience in the audit committee. Okay, now let us go to the remuneration. How remuneration is set will also have an impact on the corporate governance. All these things will have impact on the corporate governance, internal control, the audit committee, the risk, the remuneration. So all those things. So whenever you're looking in the scenario, look from a wider perspective, not just from one. How is the internal control in the organization? How is the remuneration policy set? How, are there any audit committee? Do they have independent non-executive director? What are the risks? Are they independent? Okay, you need to go for all this. Then previously we went through what are the responsibilities? How is it divided? Is one person holding maximum responsibility or is it divided? So all these things you have to look in the scenario for the corporate governance. Okay, moving to remuneration. Remuneration are set by whom? Remuneration committee. And here also minimum 3 independent non-executive director. Remuneration should promote long-term sustainable success. What does it mean? When you're setting remuneration, don't set a remuneration of your employees or directors for short term. Because if you're setting it for a short term profit, based on short term profit, they will manipulate the financial statements because they will be getting bonuses. All they care about is getting bonuses. So they will manipulate it. So don't do that. When you're setting the remuneration committee, they have to see that the remuneration is set in such a way that in the long term, the company is going to get the benefit. It will be sustainable. It will not lead to manipulation of financial accounts. Then, policy for setting should be formal and transparent. Everyone should know. It should be transparent and should be done in a formal way. No director should be involved in setting his own pay. You cannot set your own pay. Board chair can only be a member of RC, that means Remuneration Committee, if independent on appointment. If the chairman, okay, if he is independent when he was appointed, then only he can be a member of Remuneration Committee. Otherwise, he cannot. Workforce pay should be considered when setting executive pay. When you are setting the executive pay, that means the remuneration for the executive director, it should not be too high. Should not be too high. It should go with the workforce pay. You should see the market rates. What are they? And according to that work that they are doing, what is the pay? That should be reasonable. NEDs paid according to time commitments and responsibilities. See, NEDs, they don't work in the organization. They just monitor your organization and they come from time to time. Okay, they are not involved in whole day. It is the executive director. So therefore, when you're paying non-executive director, you have to pay according to the time that they have committed and also their responsibilities that they have fulfilled. So all those things, if they are there, that means it's a good corporate governance. Good corporate governance has been practiced. If it's not there, if it's against all these things, that means remuneration committee is not set. You are setting your own remuneration. Remunerations are too high. That means good corporate governance has not been practiced in the organization. So these are the ways, these are the things that you need to look in the scenario. Next, we are moving to audit committees. Before moving to the audit committees, now tell me, why did we go through all this corporate governance process here in this audit? Why is it important for our auditing perspective? You need to understand this, because when you understand only, that's the fun. Then only you enjoy studying. Otherwise, it becomes very boring just memorizing list of things without understanding why is it linked. Because good corporate governance, remember, when auditors, they go to audit your financial statements, they will look into all those things. If they see that a company is practicing good corporate governance, it's easier for them to collect evidence. It's easier for them to rely on the board. It's easier for them to rely on the evidence that they collect from the management. It's easier for them to make an opinion that financial statements are free from any error or fraud or material misstatement, because there are chances of making any error or fraud, they are minimized to an acceptable level. It does not mean that if there is a good corporate governance systems in place, that means there is no error or no fraud is taking place. No, it can be, sometimes it's hidden, but still the chances are minimized of it happening. Versus if an organization where it is totally corrupt, there is no system of monitoring, there is no non-executive director, no audit committee are set, then the chances of having any mistake, error or fraud are increased so much, which means auditor now has to perform more detailed procedures needs to be performed for them to collect evidence. And also the evidence that they collect from the managers, they cannot rely on it. They need to go for the second evidence. That's why corporate governance you have to study. It's important that the organization have a sound corporate governance. It makes the work of the auditor very much easier for them to rely on. Okay, because when an organization, when an auditor, they have this say, right? They can have a say whether they want to audit a company or not, or they can reject the client. They can either accept it or reject the client. So they, one of the bases that they do is looking on the corporate governance system of the organization also. If they have a sound corporate governance, auditor would like to accept that client. Otherwise, if they see that this is a organization where too much of things are hidden, internal controls are not working effectively, then an auditor might not want to take that level of high risk of auditing that company. So corporate governance is important from that perspective. That's why we are studying this corporate governance and rules and regulations first before we are going in detail to audit procedures and audit and all those things. So now we are going to the audit committee. All the committees are important: remuneration committee, nomination committee, risk committee, but out of all the four, audit committee is the most important when it comes for your AAA, advanced audit and assurance, right? So for this audit committee, you need to know what are the objectives, what are their main functions, what are the advantages and disadvantages. Let us first go through the objectives. There are three objectives of audit committee. If audit committee is there, it increases public confidence in credibility and objectivity also. It increases, public are more likely to trust your financial statements when it is audited by an audit, right? An audit committee is going to overview, they are going to monitor these auditors. So the public, the users of the financial statements, they know that these auditors who have audited these financial statements, they are independent because they have an audit committee that they have to report. So if audit committee is there, that is the objective of the audit committee, that they give a credibility and objectivity to the financial information. Number two, it helps the directors in meeting their responsibilities also in respect of financial reporting. Okay. Number three, strengthen the independence of external auditor. As I told before, external auditor, it will increase their independence because they have to report to the audit committee. They are independent of the organization. Next, what are the main functions? 5 main functions are there. They have to, audit committee, they review the internal control procedure. Because if your internal control procedures are not working, then definitely your financial reporting, everything, your auditing financial statements, that also will be incorrect because everything is based on that internal control. So you are reviewing that internal control also, you have to review. Then review of internal audit function. Because most of the external auditors work, they have to, at some time they have to rely on that internal audit function. So you have to make sure that that internal audit function is also working smoothly, working perfectly and accurately. So audit committee will review that also, internal audit function. External auditors also will be reviewed by the audit committee, okay, to ensure that audit has been carried out effectively, efficiently and independently. Fourth, recommending remuneration and nomination of auditors. Who hires and fires and pays this auditor? Who decides the pay, the fees of the auditor? It is the audit committee. It is the duty of the audit committee. Then review the requirements satisfied under the UK Corporate Governance Code. They have to see whether they are following the corporate governance or not. They're having sound corporate governance or not. Are they satisfying it or not under the UK Corporate Governance Code? So that is also the duty of the audit committee. Let us go to the advantages. 3 advantages. Improve the quality of the management accounting. Number 2, communication. It improves the communication between directors, external auditors, and the management. Okay. Third, avoids conflicts between auditors and management. Because if they have any conflict, if the auditors and management, audit committee will come in between and he will try to resolve the matter. So it avoids conflict. Okay. Next, coming to the disadvantages. Fair purpose to catch out management. What is it? Fair purpose to catch out management. What does it mean? They have this fear. They have this fear that they might have to catch out the management. That means the managers, what does it mean? That they might have to go against the managers. They might have to inform them that what they are doing is not right. Okay. Next, overburdening of non-executive director. Non-executive directors are overburdened because audit committees are made of non-executive director. So their role is now overburdened. They have to do lots of work now. Third, may lead to two-tier board. Why two-tier board? One is audit committee, the other one is the normal executive board. So it becomes two-tier board, and the last one is costly. It's very costly to have audit committees and all. Now, so that's it for our first regulatory environment. We have covered all the three. From the exams focus, you need to go through your test your understanding in your textbook, which is in your chapter 1, right? The name of the company is given. Test your understanding 1 you need to do to have the basic understanding of all this regulatory environment and all those things. Now coming to 2. Topic number 2 is money laundering. Very important. What is the definition of money laundering? Money laundering is the process by which criminals attempt to conceal the true origin and ownership of the process generated by illegal means. That means the criminals are doing a crime also, and now they are trying to conceal that, they are trying to hide it also. And also the proceeds, the money that they are receiving is through illegal means. It's not legal. That is known as money laundering. And it is a serious offense. It is a criminal offense in money laundering if you are caught in money laundering. Okay. So money laundering has this legislations that deals with money laundering. Criminal Justice Act 1993, Terrorism Act 2000, Proceeds of Crime Act 2002, and the latest is Money Laundering Regulations 2017. So you are supposed to know the latest Money Laundering Regulations 2017. What are the offenses of money laundering? Money laundering is an offense. Tipping off, not setting up procedure, not complying with the procedure. All these are considered as an offense. What are the duties in order to save yourself from money laundering? Client due diligence. Before you accept a client, do due diligence on them. Are they involved in any money laundering, or do you suspect them of being involved in anything like that? Then appoint an MLRO. Then staff training. Train your staff. Reporting. You have to report if money laundering happens. Internally to MLRO. And then to an external regulatory authority you might have to report if you come to find out that money laundering is taking place, or you suspect that money laundering is taking place where you are auditing. Okay. Then moving on to the client identification. Very important. Client identification and verification is a key component of client due diligence. So when you do client due diligence, these are very important things. How do you identify your client and how do you verify them? Okay, so these are some steps to identify your client. If it's for an individual, what do you have to do? If it's for a company, what do you have to do? If it's for a trust, what do you have to do? If it's for an individual, okay, you have to get the client's full name and address. You have to examine their utility bills, their driving license, their passport. Okay. Then if it's for a company, you have to obtain the copies of the following from the registrar. What are the copies that you have to obtain? Certificate of incorporation, register of directors, register of members or shareholders, and registered address. And if it's for a trust, you have to examine the trust deed. You have to ascertain the identities of trustees and beneficiaries, the purpose of the trust, and the sources of funding. Okay, all those things you need to collect as an auditor to identify your client. So that's it for money laundering, and these are some questions that you can attempt from your exam kit. Thomson and Company, Whistler, Lark and Company. Now moving to the third topic, which is Code for Ethics and Conduct. Under this, we are going to cover 4 things. Fundamental principles, the 5 fundamental principles. What are the threats and safeguards? There are 5 threats, and how are you going to, and what are the safeguards against them? Confidentiality, and conflicts of interest. Okay. So what are the fundamental principles? There are 5 fundamental principles. Number 1, integrity. The definitions are there. All these are definitions that are given on the screen. Okay. Integrity means you are being straightforward and honest. Objectivity means you are independent. You are not being biased. You are not being influenced by anyone to make a decision. Professional competence and due care. You are maintaining your professional knowledge and skill. You are upgrading to the current development. Okay. And also you have to act diligently and in accordance with applicable technical and professional standards when providing professional services. You are maintaining a standard. Okay, you will not be acting below that standard. That means you are performing with due care. Next, the other two, confidentiality and the professional behavior. Confidentiality, we are going to go in more depth a little bit later. Okay, it means you are not giving away information that you have collected from your client to third parties or anyone without their consent, without them giving you the permission to authorize it. You cannot. Okay. Professional behavior, that means you're following all the rules and regulations. Okay. And you are avoiding any action that can discredit your profession. So these are some 5 fundamental principles. Next, we are moving towards the threats and the safeguard. Okay. You have to know this in your scenario, your case study, in your exam, the scenario that you are given. You need to identify what are the threats that are breached and how to apply the safeguard, because you definitely will get a question on ethics. So this is very, very important. Okay, first you have to identify the threat. What is the threat? Then you have to assess the threat, then you have to apply the safeguard if necessary. Okay, either you could eliminate the threat completely. How can you eliminate the threat completely? Decline engagement. That means you don't accept that client at all. You are not going to audit in that firm. You just eliminate it. Okay, so the threat is totally eliminated. Second, you accept that client, but you apply some safeguard and reduce that threat to an acceptable level by applying some safeguard. Okay. To evaluate the significance, consider the materiality of the matter. You have to see how material the matter is, the seniority of the people involved, etc. So all these things you have to take care of. Next, what are the threats? Okay, so these are some 6 kind of threats that an entity can breach. And you need to know this from your exams point of view also, because you clearly have to write which thread in your cases the entities are breaching. Number 1, advocacy. Advocacy means you are promoting your client. The auditor is promoting their client. Self-interest. Auditor also have a self-interest in that entity. For example, it could be related to some fee, right? Self-review. Reviewing your own work. Auditors are making the financial statements and then they are only auditing that financial statements. So it's known as self-review. Okay. Next, familiarity. What is familiarity? When auditor becomes very familiar with the management. Management. Making decisions or giving advice. That means you are the one who are making decisions and you are the one who are giving advice. You means the auditor. But it is the role of the management, not the auditor. So it's a thread. Then intimidation. This is a thread of auditor removal. You are threatening someone. Intimidation means auditors are being threatened by the management that if you don't do as I say, you are going to lose your job, or I'm not going to pay you, like this, something like that, or you are going to remove the auditor. So it's like you are threat. So make sure that you learn this 6 types of threat and you have to link this with this 5 fundamental principles. Okay. Next, confidentiality. Confidentiality we are going to study in more depth. The reason is because in some circumstances you might have to go against that rule, confidentiality. You sometimes have to disclose the information. Usually you're not supposed to disclose information according to that confidentiality, right? Fundamental principle of ethics. But some conditions you have to disclose. What are those conditions? If it is required by law, or if the permission has been given to you from the client, then you can disclose. Sometimes if it also it is in the public interest, for example, you can see that there is money laundering, in that case you cannot be silent, you cannot hold that principle of confidentiality, you have to disclose because it is in the public interest. Sometimes such a disclosure is required to protect the members' interest. Example, in legal proceedings and all, the lawyers might need, so you have to disclose. And the client is suspected of treason, terrorism, drug trafficking, or money laundering, as I said. In that case, you have to disclose. Okay, then it is permitted or you are required to disclose. Then if you disclose it, it is not, then you are not breaching the confidentiality principle. Okay, it is not said that you are breaching the confidentiality principle if these conditions are there. If out of these conditions, if you are disclosing, then you are breaching the confidentiality principle. Then conflicts of interest, again very important. What is conflicts of interest? That means when two parties are having different interest and they are against each other. Okay, so it arises where an auditor acts for both a client company and for a competitor company of the client at the same time. Okay, so this situation is acceptable where the appropriate safeguards are implemented. Yes, it is acceptable, but safeguards has to be there. If you are working for the competitor, if you are working for a client as well as the competitor of that client as an auditor, the firm must notify all affected clients of the conflict and obtain their consent to add. You have to notify both the client that you are working for them. Okay, and you have to obtain their consent that whether you can act for them or not, act as an auditor or not, because it can lead to conflicts of interest. Next, additional safeguards must be implemented. Okay, and where the acceptance or the continuance, I'm reading from the left hand side, okay, not the diagram yet. So where the acceptance or the continuance of an engagement would, despite the safeguard, materially prejudice the interest of any client, the appointment should not be accepted. Where it can materially harm the interest of any client, you should not take that appointment, even though the safeguards are there in place. Okay, so in that case, what should you do? One of the appointment you should reject. Okay, if it is materially impacting one of the client, any one of the client, if it's impacting, you have to reject one of the appointment to add as an auditor. Coming on the right hand side, what are the safeguards that can be used against the conflict of interest? So these are some 4 safeguards. Okay, number 1, starting from the left hand side, the top left hand side, regular review of the safeguard by an independent senior partner or compliance officer. You have to regularly review. Next, use of different partners or staff for different engagements. Okay, you might use 2 different staff, right? One partner might be working for the other client, the other partner might be working for the competitor of that client. Going below, information barriers to prevent leakage of confidentiality information. Okay, you have this information barrier, you are not going to give information of one another. Okay, you are not giving the client's information to the competitor of him and the competitor's information to the client of yours. You are not sharing the information of each other. Okay, so for that you have an information barrier, that is a safeguard. Okay, then advising at least one or all clients to seek additional advice last resort. Okay, you are telling your client, you can tell one, or you are telling all the client that they have to seek additional advice as a last resort. Next, so that's it for topic 3. Now let us go to exams focus. From the exams focus, what you need to focus more on is a common question type is of the form. For example, this is a very common question that you can be asked. Identify and comment on the ethical and the professional issues where a scenario or scenarios are given. could be one scenario, it could be multiple scenarios. So in that case, you have to identify these ethical and professional issues. Number two, you should consider and explain all potential threats within a scenario. Identify actions also that you should be taking in according to conclusions about the seriousness of the threats. Propose potential safeguards and ultimately what action should be taken. You have to tell them that they have to do this. They have to apply this safeguard. You have to tell them in your answer. Then you must expand on all of these areas. That means when you are giving a thread, you have to explain it in detail. When you are giving a safeguard, you have to explain it in detail. Okay, when you're identifying an ethical issue, that also you have to explain in detail. Just if you identify, okay, it's a breach of confidentiality or breach of an objectivity principle, then you will not get the full mark. Okay, so for example, you can say it's a threat to independence. You will not get any marks for that just by identifying. You have to explain it in detail. And always look at how many marks are available for each part of a scenario. Use it as a guide to how many points you need to cover within your answer. Okay, so your marks will tell you how many points you have to write. Coming to these are the questions you can do. Okay, there are plenty of questions to do for that. You can take a picture of this. As I'm going to go to the next slide, the next topic number 4. Okay, so 4 is professional and responsibilities and liabilities. In this we are going to cover these 4 areas: the laws and the regulations in an audit of financial statements, fraud and error, auditor liability, and expectation gap. Okay, so when you're coming to the laws and regulations, ISA 250, okay, because ISA 250 is what? It is consideration of laws and regulations in an audit of financial statements. They cover the responsibilities of both the directors as well as the auditors, and you need to know both the responsibilities. What are the responsibilities of the directors as well as what are the responsibilities of the auditors? So auditors have 2 responsibilities. Okay, they have to ensure that entities are complying with the laws and regulations. It is the responsibilities of the directors, not the auditors. Second, they have to establish effective arrangements for preventing and detecting non-compliance. They have to first prevent that non-compliance does not happen, or if it happens, then they have to detect that they didn't comply. So there should be systems in the company, in the entity, and it is the job of the directors. Coming to the auditor's responsibility, they have 4 responsibilities. First of all, their foremost responsibilities is to obtain reasonable assurance that the financial statements are free from material misstatement. Reasonable assurance, okay, not 100% guarantee, but reasonable assurance. Number 2, to obtain sufficient and appropriate, both words you have to write together, sufficient as well as appropriate, evidence regarding compliance with those laws and regulations, generally recognized to have a direct effect on the determination of the material amounts and the disclosures in the financial statements. Number 2, so number 1, they will be giving reasonable assurance. Number 2, they will be obtaining appropriate and sufficient evidence. Number 3, to perform specified audit procedure, okay, to help identify instances of non-compliance that they may have a material impact on the financial statements. So if there are instances that non-compliance has taken place, they have to do some additional audit procedures to identify that, because that non-compliance can have material impact on the financial statements. And number 4, to respond appropriately if non-compliance is identified or suspected. Then you have to respond also appropriately for that non-compliance. You cannot just sit back like this and say it's not my job, it is the director's responsibilities. No, auditors have to respond for that non-compliance. Then what are the procedures that are required by ISA 250? These are the 5 things. These are the 5 procedures that they need to do. First of all, obtain a general understanding of legal as well as the regulatory framework and of how the entity is compliant. Auditor have to do this, okay? Auditor have to have that understanding of the laws and the regulations. And also how entity is complying those laws and regulations. Auditor should have this understanding. Number 2, inspecting correspondence with relevant licensing or regulatory authorities. You are seeing their relevant license that they have. We are inspecting their license and also the regulatory authorities. Number 3, inquiring of the management as to whether the entity is in compliance with such laws and regulations. You are inquiring, you are asking the manager, are they complying with the laws and regulations? Number 4, consider the results of other audit procedures. You are seeing the results of other audit procedures. Number 5, obtaining written confirmation from directors that they have disclosed all events which will involve possible non-compliance. Okay, directors are confirming that they have disclosed all the event that involves non-compliance. How do you report this non-compliance? The auditors, how do they report this non-compliance? They report this to 3 people. One is to the management and those charged with governance. The other one is to the shareholder. The other one is to the third party. They report this to the shareholder, consider implication on audit opinion. Okay, when they think that this can have an implication on the audit opinion, then they report this to shareholders. They can report this to third party also, but they need to bear in mind duty of confidentiality but also duty to public interest. You see, they have 2 duties now. One is public interest, the other one is confidentiality. So when they're reporting this non-compliance to the third party, they have to keep that in mind. Which one is more? The duty of public interest in that scenario is more, or the confidentiality? They have to balance it. Okay, you have to use your professional judgment here to balance that. To shareholders, you will be reporting only if it has an implication, if your audit opinion will change because of the non-compliance. Otherwise, you just simply report to the management. Because if you report to the management, then the management might do some adjustments and changes, and then you don't have to report it later to the shareholders and the third parties. But if it is so material, then you have to report to the shareholders. Third party, when you are reporting, you have to see, consider. Next, fraud and error. So for fraud and error, we have a standard that is ISA 240. According to that, what is the auditor's responsibility when there's a fraud? Okay, so you need to identify whether it's a fraud or an error, because if it's an error, then it's different treatment has to be done. If it's a fraud, more cautious has to be there, right? If it's a fraud, that means intentional acts of deception. It's there in your intention that you are going to do this fraud. You are intentionally doing this, you are knowingly doing this, you are willingly doing this, you're trying to hide. Okay, so it could be in many ways. For example, you are falsification of documents, misappropriation of assets, misapplication of accounting policies. You are using wrong accounting policies knowingly, right? You're falsifying the documents. All these things, all these are examples of fraud. You cannot take them as an error. Okay, error is unintentional misapplication, right? You might not be aware of, you have unknowingly done it, then it's an error of accounting policies, oversights or misinterpretations. For example, a new accounting policy took place, you are not aware of it, so you incorrectly use the old accounting policy. In that case, it is an error, not a fraud. So what should the management do? What is the responsibility of the management in this case? They have the primary responsibility for the prevention as well as the detection of the fraud and error. First of all, they have to prevent from that fraud or error from happening. If they cannot prevent, at least they have to have some systems in place that would detect that fraud and error, okay, through their internal or accounting system. Next, so we have the auditor's responsibilities and fraud risk assessment procedure and audit procedure. First of all, let us go to the auditor responsibilities. In that case, they have to obtain reasonable assurance that the financial statements taken as a whole are free from material statement, whether it is caused by error or whether it is caused by fraud. Next, maintain an attitude of professional skepticism. That means you have to have this kind of doubt. You have to challenge the management. You just cannot rely on them completely. You need to question them, challenge them. Number 3, identify and assess the risk of material misstatement due to fraud. Yes, what could be the risk of material misstatement if there's a fraud? You have to identify that as well as assess. Coming to the fraud risk assessment procedure. These are the 5 assessment that you need to do. Engagement team should discuss the risk of fraud. Remember, most of these things you can take as your answer in your scenario, but you need to link this to the case study. You cannot write this all these procedures because these are general procedures. No, take this point, link to the scenario, the facts of the scenario. Okay, if in the case, for example, in your question you have a case of a fraud, then you can take this things there but link to the case study. That's it. So engagement teams should discuss the risk of fraud. Next, consider the results of control tests and an analytical procedure. Inquire of client how they assess and respond to fraud risk. You have to ask the client how they are responding to that fraud risk, how they are assessing the fraud risk. Inquire if client is aware of actual or suspected fraud. Is your client aware? Next, consider incentives to commit fraud. Example, performance related bonuses. See, fraud can have because maybe there are some opportunities that are there in the entity that they see to make that fraud. You have to consider, you have to see, you have to identify those incentives. What are those incentives that are leading to such fraud from happening in the first place? For example, maybe your remuneration is based on your performance related bonuses. You are giving performances based on profits, short-term profit. So in that case, what would they do? They will manipulate the financial statements, they will increase revenue, they will increase their profit. You see? Why are they doing that fraud? Simply because the bonuses were performance related bonuses based on short-term performance. That's why. Now coming to the audit procedure, very important because you'll be asked audit procedure in the exam. And this is the hardest part, to identify which audit procedure you need to answer for the specific requirement, for the specific scenario. We all know review this, review that, obtain this, examine this, do analytical procedure. Okay, fine. Those are analytical procedure, but those should be applicable for your scenario also. Just if you say keep on review this, review that, does not make sense. So first one is review year-end journals and adjustments. Okay. Number 2, review the accounting estimate and errors of management judgment. Remember, most of the fraud takes place when happens in the area where accounting estimates are used mostly, where judgments are required. So that's why it's better to review those. You have to review those things where estimates, where judgments are used mostly. Because objective things, for example, cash. If you have received a cash, if you are paying a cash, it's very easy to verify through your cash book or through your bank statement if they have paid through the bank. But for example, some areas where estimates are used, for example, depreciation charge, or what do I say? There are so many other areas. So those areas you need to review. Number 3, review transactions outside the normal course of business. Why outside the normal course of business? Because that's a risky area. That's a risky area. So you need to review that. Fraud mostly happens there only if a transaction takes place outside the normal course of business. 4th, obtain written representation from the management that they have taken all the necessary steps, they are aware of the fraud, they are not involved in the fraud, they have to write that. Okay. So next, reporting fraud and error. You can report this to management, those charged with governance, third party shareholders. Okay. You have to communicate the fraud on a timely basis to the management. Okay. To those charged with governance, you have to report them if the suspected fraud involves the management. Then you have to charge those charged with governance. For example, you might have to report to the non-executive director or the audit committee when you suspect that even the management is involved in that fraud, that time only. Otherwise, first resort is the management only. When you see a fraud and error is happening, taking place, you don't directly go and start reporting to the third party or the shareholder. Okay, third party, when you report, if there is a duty to report to the third parties. Okay. For example, money laundering and all is happening. The nature is so material that public interest is at stake. that time you have to report to the third party. That time you have a duty to report to the third party. Shareholders, if it modifies the auditor's opinion, if auditor's opinion will change based on that fraud, then you have to report to the shareholder. Auditor liability. What are the auditor's liability? Auditors are liable to the client if they fail to comply with the terms of engagement letter. Example, to deliver an competent and professional service. If they are not able to deliver the service on time, then they are liable to the client. So these are the few things, okay, they need to do. For the auditor to be found liable to a third party, these things has to be there. You just cannot say auditor is liable in all cases. These things have to exist for before you can say that auditor is liable to the third party. What are these? Number one, a duty of care must exist. Okay, that means auditor should know, they must know that whoever is relying on their audited financial statements, okay, they are likely to be harmed. Okay, that they know that the injured party was going to rely on that financial statements. So for them, auditor owes them a duty of care, because auditor knows that that party is going to rely on that financial statements, and because of that it can affect them. So they have a duty of care. Audit has a duty of care for that party, whoever is going to rely on that financial statements. Number two, the injured party, they must have sufficient proximity. Proximity means closeness. He must belong to a class likely to rely on the financial statements. Okay, for example, shareholder, or the bank where the company has taken loan from, or it should be some high class, because some classes of stakeholders, they will rely on that financial statements, and some they have an option, right? If they don't want to rely, it's fine for them. It's like it's not so important for them, that financial statements. So it depend so it's for those class of stakeholders who is more likely to rely on the financial statements, who have that closeness with the entity. For example, the customer, the supplier, they rely on that financial statements. The injured party must in fact have so relied. The injured party must show that he would have acted differently if the financial statements have shown less attractive picture. Yes, the injured party might have taken a different action if the auditor's opinion might be if the auditor's opinion or the financial statements picture might have shown in a different way. In that case, yes, auditor owes them a duty of care. That means auditor is liable under these conditions. Second, the duty of care must have been breached. Number three, losses must have been suffered as a result of the breach. Losses has to be there. Some financial loss has to be there. Okay. Then only you can say duty of care has been breached. Okay. What are the solutions to the negligence problem? Restrict the use of documents to the intended use. That means documents you cannot use for any use. You can only use for the purpose that you have intended it to use. Okay. Next, engagement letter and audit report to include disclaimer clause to limit liability. Okay. You are drawing a line that from here onwards, auditor is not liable for any of the injuries that the third party is going to bear. You have to write that disclaimer of opinion. Okay. Which will limit the auditor's liability. Okay. Screening potential clients. You are just not going to accept any client. Okay, you have to screen them out. If you see that a client are less likely to be, they are less risky, right? It is more safe to go ahead with them, then you are going to take them. And if you see a client is very risky to work with them, you are not going to take them, because if you work for them, your liability you'll be liable to the third party. That liability will increase because there is so much of risk. Then taking specialized advice. You have to take specialized advice so that your liability, you can reduce the auditor's liability. Respective responsibilities to be communicated and agreed. Okay. And then insurance, professional indemnity insurance. carry out high quality work, which will reduce our liability. Then take on LLP status. Then set liability cap with client, that this is your liability, more than beyond this you are not liable. That is known as liability cap. What is expectation gap? Expectation gap means the users, okay, the general public, what do they expect from the auditor? They expect auditors, okay, that they should know everything, okay, that because they have audited a financial statements, no fraud should be there. They are checking each and everything, okay, and they believe that auditors do what they should do, what they're actually doing, okay. But in fact, auditors might not have that much of responsibility what the general public is actually expecting from them. So that is known as expectation gap. What auditors are actually doing is something different. What users are expecting from that auditor is something different. So because that difference is known as expectation gap. But there are some ways that that gap can be closed. What are the ways? Users, okay, users might be, you can inform the users so that they have a better understanding of what are the auditor's responsibilities, what are their limitations of the auditors, okay. Then you can improve the communication between the auditors and the users of the account, okay. Clarification of the liability for the fraud, that it is the management's responsibility to prevent and detect fraud, not the auditors. Clarified or improve control and education of the auditing profession. Most of the people are not aware of the auditing profession, that it is not the auditor's responsibility to identify fraud, to prevent or detect fraud, right? So educate people more and more and improve the control also. So these are some exam kit questions that you can do for this professional responsibilities and liabilities. So make sure that in your revision kit you go through these questions. If not all, but at least go through some so that you get a basic idea of this, how the questions might appear like. Next, quality control. This is, I think, this is the fourth. Yep, this is the fifth topic, quality control. So for quality control, we have ISA 220, okay, and we have ISQC 1. Okay, ISA 220 deals with historical financial information, audit of historical financial information, and ISQC1 deals with quality control for firms that performs audit and reviews of historical information, and also other assurance and related service engagements. So ISQC1 includes broader range of services. For example, it includes assurance and related services also. But ISA 220 is only for the audit of historical financial information. Okay. Next. So how can we improve our quality? How can we have that quality control? We can have the policies and the procedures to promote the quality culture, that everyone wants quality. Everyone is aware of the quality from top to bottom level people in the organization. So embed that policy and culture, that procedure. Allocation of responsibility. Give that responsibility to maintain the control to everyone. Provision of resources. You give them resources so that they can control. And leadership. Make everyone leader of quality control. Next. Okay. So you can recruit, develop, report human resources. Okay. How can you build this quality? You recruit, you develop them, you reward them. The human resources you recruit, develop, and reward. Then coming to the engagement performance. You review, supervision, and promoting consistency. Okay. Monitoring. Okay. So let us go to the first box. Hot engagement quality reviews. What does it mean? Independent review to enhance quality of assurance services. Review of quality of process that underpin areas of auditor judgment. Example, risk assessment independence. Review conducted before the firm's report is issued. Next, cold reviews. Part of firm's quality control monitoring process. Designed to identify deficiencies within firm's practices and procedures. So that you identify any deficiencies within the firm's practice. So that you can improve the quality. Okay. Performed after the assignment are completed. That is known, those are known as cold reviews. Hot reviews means before the firm report is issued, you are doing the quality control. Okay, you are reviewing. Then acceptance and continuation of client relationships and specific engagements. So to improve that quality control, you're not just taking on any client, you are going through that process from accepting and continuation of client. How you are going to accept, how you are going to continue. Ethical requirements. You have to take care of ethical requirements as well. So we are moving to the exam focus. That's it for quality control. So a common requirement in the exam is to critically evaluate the audit work already performed on an engagement and identify if the audit has been carried out to the required standard of quality. This is usually asked in section B for 25 marks question, right? There's a question I have recently done. I have just uploaded a video on that related to this question only. Question number 2 from your March-June 2021. So make sure that you go through that question and see how to answer that question, right? There this question was there. That once the audit work was already performed, you have to now comment on the quality that they have performed. Okay? To assess the quality of the audit, consider the following. So you have to consider this following, which are given in the red color. Number 1, have ISS being followed? Are the standards followed? You have to see. These are the points that you need to write in your answer. Okay? If a question is asked relating to the quality of the auditor's work. Number 2, has the work been allocated to the appropriate level of staff? That means the one who have that experience and knowledge for that work. Has the work been allocated to that person or someone who does not have the experience or knowledge? Has the audit been time pressured? Because if the audit is time pressured, making a maintaining quality is very tough. Next, has the appropriate type of evidence being obtained? Or is it inappropriate or insufficient evidence? You have to see that. Because if your evidence are good enough, if it's appropriate, if it's sufficient, okay, that means your standard of quality also will improve. The auditor's standard of quality also will improve. Has the audit being performed in accordance with the audit plan? Or was there a deviation? Has the audit been properly supervised and reviewed? Because if it is properly supervised and reviewed, again quality will increase. Okay, so make sure when you're writing this answer, all these things are there. Next, so these are some exam questions that you can follow from the revision kit. Okay, next, last topic for today, practice management. Okay, under practice management we are going through tendering, obtaining professional work and engagement letters. So what is tendering? Definition is there, the process of quoting a fee for the work before it is carried out. Okay, this will be the fee you will be getting for the work that you are going to carry out. It is already there, it is quoted before the work is going to happen, fee is decided. That is known as tendering. Okay, so because of this, competition increases within the audit marketplace. What are some risks of tendering? For example, it includes wasted time, setting a low fee, making unrealistic claims, promise in order to win the contract. Why do you do that? Because you want to win a contract. You do that, okay, you say that, okay, I will do this in 2 months or 3 months. You make some unrealistic claims, you know that you cannot make it. So these are some risks. Okay, but what are the matters that you have to consider before submitting a tender? You have to see whether you have the resources. Do you have the resources to perform that work? Competences, are you competent enough? Are you independent? Risk, what are the risks that you have to face? Specialized skills, if that is a very specialized skills, do you have that skills? For example, we did a question same from March March June 2021 paper only, question number 1 for 50 marks question. There we followed this, that the auditor was performing an audit for a specialized service. It was related to IS 41, okay, agriculture something. I kind of forgot the name of the company, but make sure that you go through that question one. So there also it's a risk because that specialized skills they don't have. They were auditing for the first time in that sector. But it was ISA 41, agriculture, something relating to agriculture. Next, potential for profitability. What is the profits that you can make from that? And additional services, okay? What goes in the proposal? So these are the things that goes. First of all, the fee. What is the fee? What is the basis of that fee? Number 2, the nature, the purpose and the legal requirement of an audit. Number 3, the client requirements and how the audit firm will meet them. Audit methodology. Outline of firm and the personnel. Assumptions that are made. For example, the deadlines, the geographical coverage, the work performed by the client, and ability of firm to offer other services. Okay, all this will go in the proposal. Next, we have advantages and disadvantages of tendering. Advantages are more efficient auditing because everyone is competing. Okay, so because of that competition, they will want to make some good quality. They might want to improve the quality because the one who makes the good quality will win the contract. So because of that, efficient auditing will take place. Then auditing can be a loss leader. What do you mean loss leader? You can set it at a low fee because there are so many things. Because higher the competition, fees will reduce. You know that. Disadvantages of tendering. What are this? Loss of long-term relationships of clients with auditors. Everyone is tendering, right? So you will not have that long-term relationship. You will be there for the short term. Then market choice reduced by the increased concentration. Okay. Low bailing, low balling, or low bailing. Okay, low bailing. That means fees are very low. Companies may constantly change auditors to reduce costs further. That's a risk. Disadvantages. So in the exam kit questions, these are the two questions for based on this area, tendering and all. Coming to obtaining professional work. So for obtaining professional work, okay, one is you look at the fee. The other one, advertising and publicity. So what does ACCS Code of Ethics and Conduct says? This material must not, okay, bring disrepute to the ACCA. Next, discredit services offered by others. Be misleading. You cannot mislead. When you're advertising and all, you cannot mislead. You cannot bring disrepute to the ACCA. You cannot discredit services that are offered by the others. And fall short of any advertising codes. You have to take care of this when you're advertising and publishing. What about the fees? So the ACCS Code of Ethics and Conduct says, basis of calculating fees should be pre-agreed and mentioned in the engagement letter to avoid contention. Okay, it should be there in the engagement letter beforehand that this is the fees that you're going to take. Number 2, fees should be charged bearing in mind factors such as when you're charging the fee, you should look at this factor, whether the staff is senior or junior, what is the experience that the staff has, what is the time that they have spent and that in that field, what is the overhead, how much expenses that they have incurred, what are the risks involved. So all this factor will decide the fee. Number 3, contingency fees should be avoided except customary. Example, insolvency work. If the fees are dependent on some factors, some conditions, that is known as contingency fee. It should be avoided. Except customary. One is insolvency work. Okay. There you can take contingency fees and all. Next, issues to consider prior to accepting an engagement. Before you take an engagement, what are the issues that you have to consider? All these boxes. You have to see the fees, you have to see the risk, you have to see the resources that you have to see the money laundering. whether the client is involved in money laundering or not. Before that, you have to do the client due diligence. You have to identify management integrity, independence and objectivity of the entity of the engaged. Professional clearance, preconditions for an audit. Reputation of the client also matters a lot because it will affect your reputation also, the auditor's reputation also. Then the professional competence. All these things have to be considered before you accept an engagement. Okay. Then these are the procedures that are necessary before you accept a new client. Okay, where the organization previously had an auditor. What about where the organization previously had an auditor? Same principles apply in respect of changes of appointment for all recurring professional work. Okay, whether it is you are continuing with the same or you are accepting a new client, this procedure will follow. What are this procedure? Okay, member asked to accept nomination as an auditor. Okay, if okay, member asked to accept nomination as auditor, then they can request the prospective client's permission to communicate with the existing client. If they accepted, what should they do? If they accepted as an auditor, okay, they request the prospective client permission to communicate with the existing auditor. That means the auditor that they have replaced. They want their permission, the client's permission to communicate with them. Okay. And if the permission is refused, then you decline the nomination. Okay. So we are going like this. From the left hand side, the first box, then we are going towards right, then down. There are two branches. One, if the permission is refused, that means the client is not willing to give you the permission to communicate with the existing auditor, the previous auditor. Then you refuse the permission. You don't accept the client. You decline the nomination. But if the permission is given, the client gives you the permission. Okay. Request in writing. You have to request in writing all the information that you need, that are necessary for you to decide whether or not to accept the nomination. Okay. Then you have to see on receipt, existing auditor requests the permission of the client to communicate with the nominee proposed. Okay. The previous auditor also, they also have to get the permission from the client before they can supply information to the new auditor. Okay. So if the permission is refused, I hope you can follow through the diagram. Okay. If the permission is refused, then what happens? The proposed nominee declines the nomination. That means a new auditor, you don't accept the client. If the permission is given, then the existing auditor should do, what should they do? They should discuss fully all information by the nominee to assist in his decision. Okay. Existing auditor, if the permission is given, then the existing auditor should discuss all the information to the new auditor, so that it can help them. It can help the new auditor in making decision. Next, discuss freely with the proposed nominee all the matters relevant to the appointment. The last two. Okay. Next, engagement letters. What does ISA 210 says about the engagement letters? States that the auditor shall agree the terms of the audit engagement with the management or those charged with governance as appropriate. You have to agree. Okay, the terms are recorded in a written audit engagement letter and should include. The terms are not recorded verbally or like that. It is recorded in a written audit engagement letter only. And it includes the following: objective and the scope of the audit, responsibilities of the audit, responsibilities of the management, identification of the applicable financial reporting framework. For example, it could be IFRS or IAS or whatever it is, whichever standard it is being used. Then the last, expected form and the content of the report to be issued. Okay, so when you're coming to the exam focus, These are the types of questions that can be asked. The acceptance of new client or engagement might be rolled to a wider ranging issues regarding ethics. So this can come as a part of an ethics question also, whether to accept a new client or not. So in such a question, always consider what steps an auditor must take to ensure that they are acting according to the fundamental principles. If you get this question, you have to see whether the auditors are acting in accordance with the fundamental principles or not. Okay, it is usually not just about whether the previous auditors reply to a request for information or not. Okay, so these are few exam kit questions that you can touch. So that's it. I have covered all the 6 topics today. Inshallah, I'll be covering the next 6 topics in day 2. So you can contact me through LinkedIn, Facebook, email, or Instagram, so that you can ask me any doubts if you have, not only regarding audit but regarding any subject. It could be regarding AFM, SBR, and all. And make sure that you subscribe to my channel, because if you subscribe to my channel and make my subscriber reach to 1K, then the community tab will be enabled for me, and then I can upload there, and you will be knowing beforehand what are the lectures I'm going to upload. You will be knowing it before, so that I can inform, because now that community tab is not open for me because I've not reached 1K subscribers yet. I need that. I think around 130 something like that. So please guys, help me out to reach the 1K subscriber, and it should be within 1 year, and I'm going to complete my 1 year by 18th August. So please help me guys, and do share this with your friends, and best of luck for your exam.